Cyprus recently and take it through in the context of Russian business structures. Pieris, I'll pass it over to you now.
Okay, thank you, Grisha. Just a brief hello from me from sunny Cyprus, 38 degrees centigrade here in Nicosia. Okay, just on the quick introduction, Cyprus has recently seen a minor tax reform in an effort to modernize its tax legislation and to make it more attractive for international investors. This was an initiative that commenced back in 2014, late 2014, in a joint effort both from the public and the private sector. This has been supported by the Cyprus Investment Promotion Agency, the Institute of Certified Public Accountants, the Bar Association, and the Ministry of Finance. As I mentioned, the aim of the mini reform is really to modernize the Cyprus tax system, to offer tax incentives to investors to set up a business presence in Cyprus, and to ensure that any changes are fully aligned with global and EU developments. The tax laws were voted by Parliament on the 9th of July 2015, and the laws were published in the Gazette and are today effective from the 16th of July 2015. The changes that were voted in this session of the Parliament was changes in the introduction of a notional interest deduction on new equity. There was an introduction of the non-domicile concept in the defense tax law, and a specific exemption is given to non-domiciles from the defense tax. There are a few anti-abuse rules, mainly which are affecting Cypriot individuals in the defense tax law, and the changes relating to the taxation of real estate here in Cyprus, again, two changes that hopefully will revitalize the real estate industry. Now, there are further changes expected. A number of bills were submitted to Parliament in July, but a number of these changes have been postponed or deferred until September, when Parliament reopens. These new changes we are also expecting is an extension of the 50% tax exemption from 5 to 10 years. This is an exemption on income generally of a person who becomes a new resident in Cyprus. They get a 50% exemption currently for 5 years. They will get it for 10 years. And there is also an extension of the accelerated tax depreciation until 2016. An interesting exemption which is currently discussed and hopefully will pass in September is the tax neutralization of the impact of Forex, of foreign exchange. This, however, will not affect trading companies, the companies dealing in foreign exchange, and also a number of other changes that will again align the Cyprus tax law with global and EU developments. For today's webcast, we will concentrate on the two major changes that have already taken place, which is the notional interest deduction on equity and the non-domiciled individuals and exemption from defense tax.
Pieris, this is Grisha. I know we're not going to be talking about that in the detail today because it's a proposed change, but just a couple of words on that impact on FX gains and losses. We have quite a few financial institutions online and quite a few corporate companies that hedge their exposures through Cyprus. Can you just once again maybe highlight how will that proposed change impact broker-dealer structures or hedging instruments that take place in Cyprus?
Yes, the exemption will apply basically to all types of entities that have foreign exchange, other than those that have as their main business foreign exchange trading. So our friends, brokerage and dealers and companies with hedge funds will not benefit from this exemption, but they will be given, in accordance with the draft law, we understand that they will be given a choice as to any unrealized forex to choose whether to tax them or to be tax neutral, but they need to be consistent year on year. But as far as other type of companies are concerned, they will basically any tax, any foreign exchange gains or losses, either realized or unrealized, will be tax neutral for other types of companies.
Okay, thank you.
So going directly into the changes, we will look at the notional interest deduction, which is the first major change. The notional interest deduction was developed after recognizing the increased need to equity finance group companies. This was mainly due to global developments in challenging, mainly back-to-back loan structures, mainly to do with beneficial ownership. So that now Cyprus, in introducing the notional interest deduction, does provide an alternative for tax-efficient ways of funding business operations. Effectively, the way that you calculate the notional interest deduction would be that you would take the qualifying equity and multiply by a reference rate. We will talk about this on the next slide. The resulting interest deduction will be a tax allowable deduction against taxable profits. The law provides that this should not exceed 80% of the taxable profit before the deduction. You cannot create a taxable loss with this notional interest deduction, and the deduction will be treated for tax purposes in the same manner as actual interest expense. And what is qualifying equity under the law? This is equity that is injected into the company on or after 1 January 2015 into share capital or share premium, which needs to be paid up. The reference rate is the 10-year government bond of the state in which the qualifying capital is deployed plus 3%, and this is subject to a minimum rate of the 10-year government bond of the Republic of Cyprus plus 3%. And you will take this rate as at 31 of December of the year preceding the relevant tax year.
So Pieris, in the context of Russia, the Russian yield on Russian T-bonds is quite substantially different on ruble papers and dollar papers. And in rubles at the end of 14, it was something close to 13%. Now it's 10 or so, and in dollars it's 5 or 6. So it's, the ruble yield is double the dollars. For purposes of an NID in Cyprus, which yield would you take, rubles or dollars?
Okay, the law doesn't give any guidance as to the different currencies, but we expect that a circular will be issued that would give guidance as to the fact that if a country that you are investing in has multiple currency bonds, which bonds would you take? So we are expecting a circular, and as a private sector, we are in communication with the ministry to develop a circular around this. My initial reaction would be that you would use the currency of the bond, which corresponds to the loan that is issued to the operating company. So if I have, as a Cyprus company, if I have lent money to lend funds to a company in a rubles nominated loan agreement, I would then take the ruble nominated government bond. This will be my initial reaction, but we are expecting a circular on this.
Okay, great, thank you.
Okay, so this covers the notional interest deduction details. Obviously, we will go through a case study that will look at it into more details. Now, looking at the non-domicile rules, this is a change in the defense tax law. Prior to the change of the law, an individual who would spend more than 183 days in Cyprus during any tax year would be subject to both income tax and defense tax. And if I remind our listeners, the defense tax is imposed on usually investment income, dividend income, and interest, basically. So now, with the change of the law, there is an introduction of the domicile concept, so that individuals will be subject to defense tax only if they spend more than 183 days in Cyprus and he or she is domiciled in Cyprus. Now, the effect really means that a non-domicile will be exempt from defense tax even if they spend more than 183 days in Cyprus. Now, what is the definition of domicile? Some of you who have connections with the UK, this really comes from the time that Cyprus has inherited all of the laws from the UK. It is defined within the wills and successions law of Cyprus. And the tax law has taken the definition from there, so that the domicile in Cyprus is considered as someone that has a Cypriot domicile of origin, subject to a few exceptions within the tax law. And in accordance with the wills and successions law, the domicile of origin is the domicile of his or her father in the year the child was born. And don't ask me why the father, but I have also checked this with the UK laws, and it appears that the UK have a similar provision in their wills and succession law, so probably we just inherited this from them. In addition to this, for the purpose of the tax law, an individual is deemed to be domiciled in Cyprus for tax purposes if he or she has been in Cyprus and Cyprus tax resident for at least 17 years out of the last 20 years prior to the tax year of question. So, simple example, if you have a Russian resident who receives income dividends from either a Cyprus company or any other company abroad, ex-company, this individual will be subject to 13% tax on their dividend income. If they are Cypriot resident but non-domicile, the effect is that they will be exempt from tax on those dividends that they would receive either from a Cyprus company or an overseas company. And also there are no CFC rules in Cyprus so as to deem the income to be taxed in the individual who is a non-domicile.
Curious from a Russian perspective. So if in a hypothetical situation, an individual Russian tax resident ceases to be Russian tax resident in the year of a large dividend payout and moves to Cyprus, let's say in the beginning of the year, and meets the 183 test day for Cypriot purposes, such individual, on the paper would cease to be Russian tax resident but becomes Cypriot tax resident on the record. And let's say in that year the individual gets a significant dividend payment from the business. There is a significant risk, given what we know, what's the happenings on this side of the border. There's a significant risk that tax authorities will try to still claim the tax residency of an individual based on central vital interest concept. What would be the reaction of the Cypriot tax authorities in trying to defend the Cypriot tax residency status based on competent authority process with the Russian Ministry of Finance, especially given the fact that Cypriot tax revenue does not gain anything from that individual being a resident of Cyprus?
Yeah. I mean, obviously, one in planning their residency should look at the provisions of the tax treaty and ensure that they fully comply with these requirements of becoming fully resident in one of the two states. The Cyprus authorities will request information from the individual to establish the facts and will interpret the treaty provisions, so where he's considered resident, in accordance with OECD guidelines. To the extent that the facts allow them, they will seek to defend the residency. And although they do not obtain any direct revenue from these individuals, by being a resident here, the tax authorities do recognize all the incidental and indirect benefits that the individuals will offer to the country through maybe VAT collections on their spending locally, and the taxation of the various businesses that are servicing and offering services to these individuals and products. So there are a lot of indirect benefits of individuals becoming resident of Cyprus, and certainly the Cyprus authorities in developing this new legislation, these new provisions, are aware of the fact that they will not be collecting direct revenues, but there is a lot to benefit out of this move. And as we will see later on, also establishing fully fledged offices and residence here with people setting up, coming over and setting up substance in Cyprus. There are a lot of indirect benefits to the country. So we believe the authorities will defend the position, but I do stress that obviously the facts will be important in this case.
Thank you. Well, that's going to be very interesting to follow, because we know that Russian Ministry of Finance has been engaged in a few instances of double taxation or competent authority process with tax authorities of other countries. Obviously, these processes are not public, so there are not many details about the facts, but given the deauthorization campaign in Russia and given the changes in Cyprus that you just, Piers, discussed, I suspect that the competent authority process will become more and more in demand between Russian Ministry of Finance and the Cypriot authorities. All right, so Piers, thank you very much. I'm going to take over from here. This was a quick summary of two most relevant, for purposes of this presentation, developments in Cyprus. Again, notional interest deduction at the corporate level in Cyprus, and the individual taxation under non-dom principle in Cyprus. And then now we're going to run through Russian tax update quite quickly, and then we'll try to tie both Russian and Cypriot developments together into a business case, which we'll present a bit later. So our audience is quite well prepared. I'm not going to run through all of these in detail, just to summarize the most relevant bullets for purposes of this discussion. On the CFC front, again, just to remind that the dividends paid out of CFCs reduce the taxable base for the Russian controlling shareholder. The IFRS versus Chapter 25 discussion, that's an interesting one. Under the current law as we stand, as everybody knows on this call, the IFRS or financial statements, audited financial statements, can be used as a basis for preparing the CFC tax calculation in Russia if the company is in a treaty country and there is a mandatory audit by the local law. Again, it's a common interpretation what the corporate rules mean, but I think generally business agrees that we're talking about mandatory audit. So if the company is in the treaty country and has mandatory audit, then you use IFRS as a basis. If not, then Chapter 25. Curiously enough, in one of the most recent letters, Minfin, Ministry of Finance, has expressed a view that they believe that if a company is located in the treaty partner country, then voluntary audit should be sufficient basis to use IFRS, which was a good news, but again, it's a Ministry of Finance interpretation of current rules. Just to solidify that point, the amendments which have been drafted by Ministry of Finance, which haven't been submitted to Duma yet, but they are at the public hearing stage, and the public hearing stage will end up in the middle of August, and we're hopeful that the draft will be submitted to Duma in the fall session and will be voted. One of the amendments in that draft is a very pro-taxpayer, I would say, and we're quite looking forward to it. The amendments are saying that if the company is in the treaty country, then IFRS is used full stop. We're not even looking at whether it's audited or not. And if the company is in a non-treaty country, then as long as there is a voluntary audit, then IFRS can be used as a basis, which is a great news. It seems like the Chapter 25, if those amendments will pass in the current form, the Chapter 25 will be used less and less as a basis for computation, which is a great news for a lot of companies in Russia. So that's on the CFC front. On the residency front, again, it's a very relevant point for this discussion, although not the center pivotal point of our case today, but it is relevant. Just to remind that the place of where board of directors meet and where directors meet and make their decisions was removed in the spring amendments. So now the Russian rules only look at operational, if you will, day-to-day management, where the actual management and control of the company takes place. Interestingly enough, Ministry of Finance has issued quite a number of rulings and clarifications and guidance on application of new rules. And just as a matter of short advertisement, in middle of September we'll do a separate webcast where we will summarize all of the guidances that Ministry of Finance has issued in a user-friendly format for you, for everybody who's on this call. But curiously enough, by purpose or not, there's a very limited, virtually no guidance on interpretation of residency. There's some guidance, but it's quite literal and doesn't shed much light. So that residency becomes still in very unknown and the least interpreted area by Ministry of Finance. On the beneficial ownership, the main topic that we will consider during our case study today, quite a number of good letters from Ministry of Finance on what facts and what evidence the Russian tax agent, the company that's making outbound payment, should look at in order to confirm whether the recipient of Russian source income is a beneficial owner or not. You all know those rules. The most recent one was in March 2015, where again Ministry of Finance said that they are not looking for the form, if you will, the legal form of documents as much as the content, and they're looking for, and at the moment there's no prescribed list of documents which need to be collected, but on the content, on the substance basis, that's what they're looking for. And again, we know that the Ministry of Finance will, within medium to short term, Ministry of Finance will prepare the form, the self-certification form, based on which the tax agent, which makes the outbound payment, will be able to safely say that they're relying on the treaty protection. The court cases that are out there are clearly saying that back-to-back structures no longer work. The tax authorities are quite cognizant of those. They're aware of back-to-back arrangements and interest flows and royalties. So those, if there are still companies in the market that use them, that is definitely not sustainable and need to be looked at in the future. And for thin capitalization, just a very quick update again, as everybody knows, quite a number of court practice pro-tax authority or against the taxpayers, which all unanimously, except one, Tele 2, all unanimously say that loans from sister companies are within the scope of thin cap. So that's just a quick update on the relevant topics on the Russian side. And now let's look at the case study. Again, as a matter of disclaimer and caveat, this is just for illustration purposes. By no means this is the advice or expression of view, where the purpose of this illustration is just to show the principle of how the new Cypriot NID would work. We are only looking at application of Cypriot notional interest deduction in this case, and the Russian withholding tax on the outbound payment. Naturally, there will be CFC implications depending on who the shareholder of those companies are. And we on purpose didn't put the shareholder on the slides just to not confuse the discussion. If there is a Russian controlling shareholder on the top of these companies, the CFC implications naturally need to be addressed and considered. And again, the CFC impact can be mitigated in certain cases. So let's look at application of notional interest deduction and how this would work. Again, back to back, the most typical structure used, EXCO, regardless of where it is, debt funds Cypriot company on lends the money to Russian company in a back-to-back arrangement. Cyprus leaves behind a short spread on the interest. Historically, this was used to park the profits in the tax haven and minimize or avoid withholding tax out of Russia. Like as I said earlier, these structures are completely transparent to the authorities now. In the context of information exchange with other countries, that will be less and less sustainable. And again, we're talking about interest here, but it equally applies to royalties as well. So as a modification of the way how Russian business could be funded from foreign side of the business, let's examine the situation where EXCO, instead of debt funding Cypriot company, puts equity capital into Cyprus, and Cyprus extends the loan to interest-bearing loan to Russian company. So from the cash flow perspective, from legally binding cash flow perspective, let's put it this way, Russia has a loan from Cyprus, and Cyprus is equity funded by its shareholder. From Russian purposes, we would naturally say if these companies are related, the thin cap applies. So let's assume that we're safe on 3-to-1 ratio. From beneficial ownership perspective, with proper structuring, and I must say that that beneficial ownership issue does not go away. It still has to be considered, but with proper structuring, with a lack of legally binding obligation of Cyprus to pass on the money elsewhere, with a proper staffing of a Cypriot company on the management level, and with proper governance at the director level, with their proper authorities to make decisions, the strength from the beneficial ownership position of this structure is naturally much stronger than the previous one where back-to-back is used. And on this slide, we do have this blue arrow with the dividend flows. That is optional. It doesn't have to be there. So we could take it out and just say Russia pays interest to Cyprus. Cyprus accumulates earnings, and those earnings are later on either reinvested by Cyprus, re-lent back to Russia, or distributed to the shareholder. For purposes of continuity, we just and for purposes of comparing with the previous example, we showed the upstream cash flow in the form of dividends. But again, it doesn't have to be there. If it's not there, then a beneficial ownership test is even stronger. If for various purposes CIPCO needs to bring money up to the shareholder in the form of dividend, we would naturally suggest to structure it such that it's not mirrored to the interest payments. It's less frequent and with different terms, different amounts, etc. And we do need Cypriot directors to exercise absolute power to accumulate interest earnings and distribute dividends when and if they decide. So on the Russian side, if everything works, we get the interest deduction, interest deduction for corporate income tax purposes. So we get 20% tax shield. In Cyprus, the mechanics are that, as Pierre walked us through earlier, we do show interest income, but then we get the notional interest deduction up to 80% of interest income received. Again, within the thresholds, the Russian 10-year T-bond, like I said, in rubles today is around 10%. The check should be made as of 31 December a year prior to the taxable year. So I presume if we're looking at 2015, it's December 31, 2014, when the ruble rate was, the 10-year ruble T-bond yield was around 13%. So for ruble lending, the 2015 threshold is 13 plus 3, 16%. It's quite high. Most of our Russian clients borrow rubles from inter-group lending at the lower rates. For dollar lending, it would be 5 or 6% plus 3, which is 8 and 9. Again, still quite high threshold. So I think for Russian lending, the T-bond yield provides us enough room to take advantage of 80% deduction in Cyprus, which takes the effective rate in Cyprus down to 2.5%. So from the effective rate perspective, in Russia you get 20% shield, and in Cyprus you get 2.5% tax. The effective tax impact 17.5%. Again, as a caveat, if earnings are accumulated in Cyprus and it does create the CFC taxable base for the shareholder up on the top, then there could be mitigating strategies for that, but those are beyond the scope and purpose of this call. On next slide, on slide 21, I think I have covered most of that in my previous speech. Again, it is critical to confirm that Cypriot company Sipco is the beneficial owner. But again, don't forget about tax residency. That there is a new novelty to Russian tax environment. We do need to ensure that Cyprus company is treated as a Cypriot tax resident to qualify for treaty purposes, which means that we need to ensure that it's managed and controlled, not out of Russia at least, and at best out of Cyprus. Pieris, before I pass over to you to talk more about the creating residency and substance in Cyprus, the question, and it's actually a good bridge to what you're going to say by creating Cyprus substance in Cyprus. A lot of our companies in Russia now are actively thinking of. Actually, quite a few companies on the call today have already made a decision and moved their top management to Cyprus to create substance, and that naturally falls into the discussion of taxation of individuals in Cyprus. But before I pass over to you, we talked about competent authorities for the individuals. For companies, naturally there will be a desire from Russian authorities to claim that the Cyprus company in this instance is a Russian tax resident. What would be the approach of Cypriot tax authorities, provided we do our best by creating governance, creating substance and functionalities? What would be the approach of Cypriot tax authorities in negotiating and defending the Cypriot tax status for Sipcos in this case?
There is an expectation of Cyprus authorities that this may be an issue that they need to deal with. We know that currently a company in Cyprus can obtain a residency certificate by just self-certifying to the authorities that it is managed and controlled, and the authorities here in Cyprus would issue the residency certificate with no questions asked. However, we are aware that this practice is currently under review by the Cyprus authorities in an attempt to make a more detailed review of the status of the company so that they are ready to deal with any possible challenges. We don't have many details, but what we are expecting is that when a Cyprus company requests a residency certificate, they will be asked to complete a relevant questionnaire that would look at a number of questions that need to be answered, which will indicate that the Cyprus company is properly managed and controlled from Cyprus, and will also allow the Cyprus authorities to scrutinize the facts in more detail. We believe this will give them sufficient grounds that would allow them to support the Cyprus residency in case of challenges by the Russian authorities. And in fact, on the next slides, I have a little bit more details of this. So shall I go on to the next slides?
Yes, please go ahead.
Okay, so I mean, as I said, the Cyprus company is treated as a resident if it is managed and controlled from Cyprus. The authorities want to make sure that there is more strengthening on these management and control criteria. As I mentioned, they are looking into applying a questionnaire that would look at the board of directors meetings, where they're taking place, whether any powers of attorney are issued, where the books and records are maintained, and a number of other questions around the management of the company. So certainly what you mentioned earlier, Grisha, on setting up full substance and and being able to take decisions from Cyprus would be some of the questions that would be asked on the questionnaire, so that the Cyprus authorities will have this on file in case any challenges come along regarding dual residency. And on the next slides, what we have put here is a number of incentives to encourage companies to set up substance in Cyprus. As we know, the current personal tax rates are from 0 to 35%. There is, however, an exemption for days performed outside of Cyprus. As long as these exceed 90 days, you get a full exemption of that income. And also for those taking up first employment in Cyprus and earning above 100,000 euros, there is a 50% exemption of that income, currently for 5 years. And as I mentioned earlier, this is planned to be increased to 10 years. So for the first 10 years, they will get a 50% exemption on their income. If their income is below 100,000, they are entitled to a 20% exemption, currently for 3 years, capped at 8,550 euros. And again, this will be extended from 3 to 5 years. So there are incentives for people, for companies to send people over and take up a residency and employment here. In addition to this, obviously, we mentioned the new non-domicile rules, which give an exemption on the investment income, so that if it's either top executives who may also have share bonuses or share option schemes, the income receiving from those shares will be exempt as non-domiciled. And just to complete the picture, in Cyprus we don't have any wealth tax, so that they will not be subject to any type of tax on our global assets. And finally, just an example of how these incentives work. If someone has an employment income of, say, 150,000 euros, and assuming a 50% exemption, they will pay total taxes of 20,000 euros, which gives you an effective tax of around 13%. And if this individual has a dividend income of any amount, this will have no Cyprus impact at all, so no tax on the dividend income. So I think that concludes our part of the presentation. Richard?
Yeah, Piers, thank you very much. I mean, this, I think we made it good on timing, left enough for questions if there are any. I don't see anything on the screen as far as the questions, so we'll give a couple of minutes maybe for people to think of something and type up. But in principle, as I think about it, Piers, the notional interest deduction, while it's new to Cyprus, in principle, it's similar to what we have been accustomed to in your 80% deduction on royalty income. So I mean that the IP regime that we know in Cyprus has been around for quite a while, and I know a number of Russian companies are successfully taking advantage of that. So in principle, I think it's somewhere in the same category. Where
in fact, Grisha, I just want to add that before introducing the law, the government did obtain 2 independent opinions from EU experts, external EU experts, who confirmed that the provisions of the legislation are in line with EU conditions and regulations. So we are quite comfortable. The government is quite comfortable that this is within the context of EU legislation.
Very good, excellent. If we don't have any questions, then I'll maybe just say a couple of words in Russian at the end. Дорогие друзья, спасибо огромное за внимание. Слайды презентовались на английском, но у нас будет также и русский вариант, поэтому если кому-то нужны слайды на русском языке, просто обращайтесь к нам. Контактная информация на экране, мы с удовольствием с вами поделимся либо английскими, либо русскими слайдами. Again, thank you very much, everybody, for tuning in. I hope it was useful for you, and stay tuned for further webcasts and debriefs from Deloitte.
Thank you all.
Have a good day, everybody.
Thanks.